Today, property prices recovering? Well, maybe not. Hello again, it's Martin North from Digital Finance Analytics, our latest post covering finance and property news, including a distinctively Australian flavour. Well, today we're going to look at the CoreLogic data and also the latest from the ABS relating to lending standards. So we're going to start with CoreLogic, and in fact, Westpac did a very good summary of what's going on, and I'm going to take you through that and also make a few comments as we go through. So the CoreLogic Home Value Index, which covers the 8 major capital cities, rose 0.8% in March, following a 0.1% dip in February, and 7 straight months of falls in the 1 to 1.6% range between May and December. The latest gains comes despite interest rate rises in early 2023 and widespread expectations of further rate increases in the months ahead. With seasonality also flattering the results, price gains narrowly based and trading volumes still very thin, we have to be very wary of interpreting the March rise as the beginning of a sustained recovery. Instead, it looks to be some form of stabilisation at best. Whether even this can be sustained, though, is also questionable given the interest rate and wider economic headwinds bearing down on the housing sector. Stop-start periods, alternating between stability and price slippage, are in fact fairly rare for housing, but are not unheard of, particularly when rates remain high and the economy is moving through a substantial downturn. So we expect this to be the story for 2023, but are also alert to the possibility of a sustained stabilisation emerging earlier on in the piece. All major capital cities saw some improvement in March. Sydney posted a strong price gain. Melbourne and Perth recorded relatively solid rises, but prices were flat in Brisbane and Adelaide. Smaller capital cities saw further price declines, with flat results across most regional areas. And turnover was fairly mixed, up 1.3% over the quarter as a whole, but down in the March month after a strong gain in February. And Westpac estimates have seasonality adjusted sales, by the way. Sales volumes remain low, tracking near historic lows as a proportion of the total dwelling stock in New South Wales and Victoria. Sydney recorded the strongest price rise with a 1.4% lift in March. Seasonality flattered the results a little, and prices were up 1% over the month in seasonally adjusted terms. Top and middle tier houses saw the strongest gains. Top tier units also were up solidly. It's worth recalling that the Sydney market registered the largest correction in 2022, with prices falling 13.5% peak to trough. Melbourne posted a 0.6% rise, and that's the biggest monthly gain since November 2021, and top-tier houses again outperformed slightly. Turnover remained very weak, though, with sales down 18.8% over the quarter in the first quarter. Prices were essentially steady in Brisbane, actually down 0.1% over the month, and Adelaide up 0.1% over the month. In both cases, slight improvements on price slippage in February. Adelaide remains the strongest performer over the year, with prices up around 3% across the year. Perth recorded a 0.5% gain, the biggest monthly gain since May last year. As with Adelaide, prices are still up on a year ago, annual growth holding at around 1.9% across the year. And across the small capital cities, Hobart is now the standout weak market, prices tumbling a further 0.9% in March to be down around 12.9% across the year. That's an annual decline which has overtaken Sydney, with houses and top-end units leading the decline. Canberra saw a 0.5% fall and down 8.1% across the year, and Darwin saw a similar 0.4% decline, but with prices still up 1.6% across the year. Across the regions, prices were flat in regional New South Wales, down 0.1% in regional Victoria, but up 0.3% in Queensland, and annual price growth is still firmly negative for all three areas. And in February 2023, in season-adjusted terms, according to the ABS, the value of new loan commitments for total housing fell 0.9% to $20.6 billion after a fall of 2.4% in January. It was 30.9% lower compared to a year ago. For owner-occupier housing, it fell 1.2% to $15 billion and was 30% lower than a year ago For investor housing, it fell 0.5% to $7.6 billion and was 32.6% lower compared to a year ago. And in February, in season-adjusted terms, the value of external refinancing for total housing rose 2.7% to $19.9 billion and was 22.6% higher compared to a year ago. And for owner-occupier housing, it rose 3.5% to $13.6 billion and was 26.4% higher compared to a year ago. Whereas investor housing rose 1% to $6.3 billion and was 14.9% higher compared to a year ago. And first-time buyers continue to be hit. At the national level, it fell 3.5% to just over 7,000 after a fall of 4.6% in the January month. And it was 57% lower than the January 2021 high and 26.7% lower than the pre-pandemic level seen in February 2020. In New South Wales, it rose 5.9%. In the ACT, it rose 14.9%, and the NT, it rose 3%. Western Australia fell 7.3%. Victoria fell 2.7%. In South Australia, it fell 4.9%. In Queensland, it fell 0.5%. And in Tasmania, it fell 2.2%. So the point to make here is that we've got clear evidence of weaker lending. And as I've argued many times, weak lending leads to falling house prices. And whilst there has been some stabilisation in some markets, in fact, the aggregate numbers don't tell the full story. In some areas, in some markets, property prices are still falling quite fast. In others, they're holding their gain a little more, particularly at the top end. But given that we've got the mortgage rate cliff ahead, given the fact that the RBA is at some point probably likely to raise rates again higher, whether it will be this month or next month is an open question, I still think there is more downside risk to property prices. And in fact, I think this risk could be with us for not just a few weeks, but potentially through this year and into next year. Remember, the RBA is still thinking that inflation will be above target until the next couple of years. So those people, property spookers particularly, who are claiming that this is the bottom and now is the time to buy, are telling you just half the story. The truth is that with tighter lending standards, and with potentially more people getting into mortgage stress, and I'll cover that in a future show, I think that property prices have further to fall. And of course, it's also worth remembering that the CoreLogic numbers are between 6 and 8 weeks behind reality. And so not all the interest rate rises have actually hit so far. Another reason why we think property prices will continue to slide. Sure, there are more people looking and there is limited stock on market. And I'd also make the point that the stock at the moment on market is containing a lot of property that is really not top notch. A lot of investment property is being sold at the moment. And also quite a few people who are trading up are doing so on the hope that they can do it quickly and move into a property that doesn't require significant renovation or improvement. So these factors are worth thinking about in the context of property price movements. And finally, of course, the migration question is important too. Migration is massive. It's been higher now than we've seen for a long, long time. This is going to put some support to prices, but remember that many migrants don't buy property in the short, that these migrants are actually supporting property prices at all. So, as I say, just be a little cautious of these numbers, expect more slides, and if you are thinking of buying at the moment, don't necessarily be misled. Remember that it is certainly possible that prices will be cheaper later. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.